Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to get right to it, see what's going on today. If you want to follow me at Finance Square Finance, and you can join our community, finding-value.com. We've got a bunch of people in the community that are very focused on commodities. That's kind of what I talk about since that's where I think the value is right now. And we've got a midweek update that's been released today. You can check that out on the website. And today is the last day for that special coupon code for that to be active. So you have to sign up now or miss that at least window for the special. And the discount code is special. That's the discount code special. So you get 50% off the first month, or you get a larger discount on the yearly membership, and this is the last day to use it. So we've got decentralized, and he's trying to call out Sahara's charts. He goes, so far, I'd just be losing money hand over fist if I followed any of your calls. And he's talking about some flip flopping. He's got the diamond here, some of this rising wedge breakdown, rising diamond call breakdown. So what's going on here? Here's the thing. You can't charting only works a certain percentage of the time. It's not 100%. So you have to rely on strategies. You have to rely on other things than just charts to make money if you are going to use charts. I do look a lot at the charts, and I do a lot of ratios and market conditions. I chose those three pillars because none on their own are worthy for standing by themselves. So if all you did were cycles, you would be close, but you wouldn't be as good if you understood the ratios and if you understood technical analysis. Technical analysis alone, in my opinion, isn't enough to make investment decisions. The whole name of the game is to increase your probability of success. Technical analysis has a probability of success. Now, some people say, what exactly is it? It's not about how exact it is. It's about defining a strategy that will work with a higher degree of success. Now, chart patterns, depending on what you add with it, the success rate is very high or very low. Because if I know where we're at in the cycle, and if I know what the ratios are at, it increases my probability of success if I see a bullish falling, a bullish falling wedge. Because I know it's cheap and I know the cycle's turning, it increases my probability of success. Now, if you only use the technical analysis, you don't know anything about the fundamentals of the company. But if you knew a whole bunch about the fundamentals of the company, it increases your chances of success. So if I was a technical analysis person, which I am, and if I looked at the fundamentals and looked at the quarterly earnings conference calls, and I knew where the ratios were at, and I overlaid more technical analysis on ratios and on top of market cycles, that for surely will increase my probability of success. Now, I don't trade in the short term. I'm a long-term person. So some of these people, all they care about is short-term movements. That's not what I do. What I do is I look and I say, this looks like a top, which it does. Now, can you nail tops? It's very difficult to do it. That's why I don't trade in the short term. And this guy is getting a lot of crap from this guy, and I don't know why he's doing this. He's just trying to share opinions, and this guy's trying to rip them apart. It's like, whatever. But this is showing topping characteristics. And that's what you have to go with. And you're not going to be 100% right. That's part of the game. Part of the game in technical analysis, and technical analysis is measuring the sentiment, basically, and the money flows in the market. Ratios will tell you what's cheap and expensive, and market conditions, which is cycles, can tell you where you're at in the cycle. You can't get much better than that, in my opinion. It says, Dear son, 97% of depression in young men nowadays is caused by lack of money and heartbreak. Do you agree? No, I do not agree with that. So here is my opinion on it. I think that a lot of depression, irrespective if it's young men or anyone, has more to deal with diet and what that person is doing. So if a person just stays inside all day and games all day by themselves, and they eat crappy food, I think it's going to have a large impact on how they feel. If they eat highly nutritious food, they're outside in the sun getting enough vitamin D, and they are interacting with people of their relative same age, and they're doing things that they like, uh, specifically outside, if you're getting enough sun, I think that would drastically change depression. There are the gut microbiome in people. Uh, Whatever you eat, that gut microbiome will grow. So if you eat crappier foods, we'll call it sugars, um, foods that aren't recognizable, like you don't see them in, we'll call it the environment. So you're not eating meat, or you're not eating vegetables and berries and whatever. If you're eating Cheez-Its, Kraft, Kraft stuff, McDonald's, breads, all these different things that we haven't really eaten, and our genetics don't know what the heck to do with it. I think that people are eating a lot of that type of stuff, growing the wrong microbiome, gut microbiome. It has an impact uh, with your brain, and your gut communicates with your brain. And I think that a large portion of this deals with diet and not getting enough vitamins, specifically vitamin D would be one of my guesses. And then also not having a good sleep schedule and stuff like that. I think it's a combination of all those things, and that's what's causing it. And I think computers and cell phones are having a large negative impact on the happiness of people. So off that soapbox, U.S. 10-year rates. Look at the 10-year rates on the long term. Down, up, down, and we have started an upward move. Yields are going to cause money flows in the system to change. And we're at the beginning of this change. And a lot of people, I think, are not really fully understanding or grasping this change in the 10-year yield. What does well when the 10-year yield goes up? And I don't expect it to go straight up. We could easily cycle up and down. So don't go crazy there. But I think precious metals will do incredibly well because that's what did well last time. I also think that oil could do incredibly well, commodities and hard assets in an inflationary environment. And there's zoomed in on that right-hand side, breaking out of that consolidation. So it looks good for yields to continue higher at this moment. Oil in the Nasdaq and S&P 500. Is this the beginning of a bigger move? And remember, these yields breaking out September of 2021. It's a big deal. Here we go. Bull in the Nasdaq in the 80s, outperforming all the way to 99. We had a bull market in oil where oil outperformed the Nasdaq. It ended in 2008. We had a consolidation, one hump, two hump, third hump, and that ended in April of 2020, March, April of 2020, when oil went negative. It was that big blowout selling pressure move. And then we are now, in my opinion, in a bull market move where oil could easily outperform the Nasdaq. Now, some people say, well, it didn't do it the past year. Guys, we're talking secular movements, not small cyclical movements. This is like explaining to people 1 plus 1 equals 2. And then 5 plus 5 equals 10. But you could also get 4 plus 6 equals 10. You can also do 7 plus 3 equals 10, right? So it's the time frame that these things are that we're looking at. You're looking at the wrong time frame. You need to look bigger picture. You need to look at the big downward move, the upward move, the downward move, and then we are starting, in my opinion, a potential new move again in the bull oil regime. If we scroll in on the right-hand side here, we are starting to break out where oil is starting to outperform the Nasdaq. Now, is this going to continue? It looks like it to me. We just started to break out. So we'll see if this works our way on up. Now, do I put on a position? Do I use technical analysis only? No, but the oil companies are cheap. We are in this bull cycle and we're starting to break out of this falling wedge. I would be long oil because it's cheap. And if you look at other metrics, you can also see that that's also cheap. And here's oil versus the S&P 500. You can see how cheap we are in comparison to history. In the 1980s, we were at 0.2. We're at 0.01. Now, we're in a big bubble in the S&P 500 perhaps, or maybe not, we'll see. Or maybe oil has a very long way to move higher. The last bull market was from 1999 and this big bull market move here to 2008. And then we came all the way back down and doing a big double bottom down here. We zoom in on the right-hand side, we are breaking that squeeze in the corner to the upside. And we're getting the big green candlesticks, the small red candlesticks, and that's generally the ingredient I look for in a potential bull move higher. I think that's pretty good. BTC, monthly spinning top, needs negating to ally fears of a meaningful top. Is this a Weinstein stage 1, stage 2, and stage 3 top? And then the stage 4 is the big recession. He's got the spinning top, which is this big wick at the top candlestick that he is potentially saying. And look at the people going off on this guy. What have you last been correct about? I want to see if you have a good track record. We're going to 0. People are getting all sorts of pissed off because they don't want to see this could potentially be a top in Bitcoin. Now, here's the thing. If oil starts to outperform the Nasdaq, this one here, what does this mean? It means that money flows might start to be changing differently in the market. People are starting to get long crude oil and away from the Nasdaq, and interest rates could be a driver of that. And that's what the interest rates moving up like this could be a driver of that rotation. So Bitcoin could be, and I think this is what it is, I think it's highly correlated to the Nasdaq. And if we see a sell-off in the Nasdaq, we could see a big sell-off in Bitcoin. But nobody wants to hear that. They don't want to hear that it's correlated to the Nasdaq and the Nasdaq could go lower. We have a lot of new investors in Bitcoin. A lot of Gen Z and whatever. And you know what happens to those people? They get absolutely slaughtered. Their money gets taken from them by professionals. And that's what happens to new investors, and then they have to learn. So we'll see what happens here. I'm going to continue to watch it and share it. Here's an article Christine is sharing. It says, Twilight in the Permian Basin, shale wells producing more early on, and then they are declining faster than ever. This is a huge thing to be watching is oil production. Oil production is everything. And people have no idea about this. They think tech. Tech is a function of efficiency. Oil is a function of moving the real things in the world. It's also in everything. The number one commodity. So it's transportation and in everything. I mean, everything, guys. We're talking medical devices, medical pharmaceuticals. It's in this computer. It's everything. It's in clothing. It's in waxes, lubricants, jellies, freaking everything. Uh, Food is a conversion of oil, basically, or diesel into food. It's in fertilizers. It's in absolutely everything. So if we have problems in oil and we can't slow down the money printers, that disconnect between the two is your inflation problem. Bravos research says the 1920s saw the greatest stock rally ever, followed by the worst crash in history. Today's market is following a similar footpath, and that's the fractals that he's got overlaid. Those are fractals that he's trying to maybe overlay here. Now, are we going to be like the 1920s? I doubt it, because that was a huge real estate market bust that basically caused deflation. The 1920s is the exact same as the 2000s with bank lending, if you look at history. And then the loans that were made in the 1920s went bust, and all of those homes and those loans of those homes went back to the banks. And the banks were sitting on major losses because of the loans that they made in the 1910s and 20s. So I don't think we're anything like that. I don't think it's a 1920s. We have the same fractal, but I don't think it's the same driver. If oil does roll over, that could be a driver that causes interest rates to continue higher and cause a big crash. That very well could be the case. Trump, interest rates are far too high. The last time Trump said something was too high, it was the dollar back in January of 2017, just days before his inauguration. Here's what he said. He says, our companies can't compete with them now because our currency is too strong and it's killing us. Last year, he called recent strength a tremendous burden on U.S. businesses. Trump understands the impact of a strong dollar, and the same logic applies to high interest rates. They suppress exports, hurt corporate earnings, and slow economic growth. What happened next? Well, the dollar began a significant decline, setting the stage for one of the most pivotal macro moves we've seen in years, triggering a melt-up in risk assets. Deja vu? I think so. Let's see how it plays out. And this is the Trump dollar too strong mix and potential move. So what you have to do, what he has to do is pressure is mounting in the interest rate market. The interest rates that we showed in this white here, that breakout, if he wants to hold interest rates down, he transfers the pressure and the interest rates back to the dollar. And then the dollar will decline. If the dollar declines, it will push commodities and emerging markets higher, is what it will do if he does that. Peter Schiff says, here's a chart of the CRB showing commodity prices soaring, up over 28% in the past 7 months, hitting a 14-year high. How can the Fed look at this chart and conclude inflation is headed lower? Inflation will drive both consumer prices and bond yields sharply higher in 2025. Well, they're probably saying it's not as bad as it is because they have to lower rates for the economy. That's probably what they have to do. And they're stuck in a hard place. They can't tell you that inflation's out of control and then lower interest rates. Because if they want to save the economy, they got to lower interest rates. So I don't know what, they're in a predicament. Navi says speculators are currently holding one of the largest short positions in the futures market on record for the Canadian dollar. We've seen the Canadian dollar go down, and this could reverse, causing a spike in the Canadian dollar, especially if the dollar starts to weaken. Talking about up here, the DXY. They're all interconnected, guys. Everything is interconnected that I'm showing you. Every single slide that I've showed you is all interconnected in the cycle. It is a function of where we're at in the cycle. Eric Nettles says, energy funds experienced massive net redemptions last year, largest since at least 2016, resulting in ongoing selling pressure. We are optimistic that with record high oil demand, record low oil inventories, normalizing OPEC spare capacity, the twilight of U.S. shale, and meaningfully improving natural gas fundamentals, that sentiment could shift this year, resulting in funds flow tailwinds versus the headwinds that we've seen in 23 and 24. And that's what moves markets, money flows, ETF inflows. Silver production in quarter three 2024, Fresnillo being the biggest silver producer, KGHM, Newmont, Hinduistan Zinc, Pan American Silver, Southern Coppers down here, Mag Silver, Glencore, Dijin, and then some smaller ones that I can't really read very well. Our European transport fuel use has not decreased below the post-financial crisis average, despite a 72% increase in renewable in 2010. The main changes have been reduced fuel use and substitution of gasoline with diesel. That's really what they're subsidizing there. Jason Zweig says, the skittish investor, no matter how intelligent, is always susceptible to getting flushed out of the market by the brush beaters of doom, says Peter Lynch. Jason says, the intelligent investor is a realist who sells to optimists and buys from pessimists. Brady says, silver, this chart is what contrarian investing is all about. Backtest is soon finished. Lifetime opportunity is made use of. The tide is turning, and that is silver versus the US stock index Dow Jones. And we have to buy patterns if you want to get in early, not breakouts necessarily. But this is broken out on a ratio chart, and it looks good. It looks good. Silver is going to do some crazy stuff here, guys. I hope that you guys can hold on. Kathy Wood says, calling for 1.5 million Bitcoin price by 2030. She was calling when at the bottom of the oil market. She was saying that oil would never go above $20, $20 or $25 or $30 again, ever. It's going to go the way of whale oil. She is probably as clueless of any analyst that I've ever seen. Absolutely clueless. She's going to get smoked on this call here if we get the next decade of oil outperformance and Nasdaq underperformance, because if Bitcoin is just an extension of the Nasdaq, good luck, what I'll say. The Great Marty says, is inflation about to rocket? Yields are warning us all. So remember the yield that broke out that 40-year downtrend that we saw earlier? That's what he means by yields are warning us all. The 1970s all over again. So look at this. West Texas Intermediate crude about to break out to the upside. Big move. Copper has the 3-hump consolidation, and it's about to break to the upside, perhaps. Lumber, shoulder, head, shoulder developing. Then U.S. government bond 10 years already broken to the upside. Is he right? I tend to think so, but he might have his, we might be off in his timing, but it sure looks good, like it could happen any second. So what am I doing? I'm taking a viewpoint that this is right. And I'm playing the long end on oil and commodities and all this stuff. So I think he's right. Yeah, and that's where we're gonna end it, guys. So that's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website. That's all I've got, guys. So we'll catch you next time. This is Finding Value.